Imagine a company that almost overnight just completely abandons its entire business model. I mean, we're talking a complete 180.
Yeah, a total U-turn.
From social media marketing to hoarding Bitcoin like, well, like a digital dragon. Is this the most brilliant corporate pivot of the decade?
Or maybe a high-stakes gamble destined to become a cautionary tale for the digital age.
Exactly. That's the electrifying question we're diving into today. Welcome to the deep dive. We're tearing into Asset Entities Inc., ticker ASST, soon to be reborn as Strive Inc.
And this isn't just, a little tweak. It's a historic inflection point.
A complete corporate metamorphosis, our mission. To unpack this audacious, truly bet the company move, we're exploring its past, its speculative present, and its, frankly, incredibly uncertain future.
We'll look at the business transformation, the new leadership stepping up.
Right, the financials, market sentiment, who owns what, and of course the risks. This deep dive is all about getting you well-informed on this huge shift. To make this complex story crystal clear for you, we've organized our discussion into two main parts.
Makes sense.
First, we'll lay the foundation. We'll cover the company's dramatic business change, the new leadership, and the financial state of affairs.
The before picture, essentially.
Exactly. Then we'll pivot to the future. We'll examine market sentiment, who actually holds the cards in this new entity, a thorough risk assessment, and our concluding outlook. Before we plunge in, just a quick note. This deep dive comes to you with insights that we've carefully extracted, much like what we offer at Stock Analytics AI.
Good point.
Remember to like and subscribe to Stock Analytics AI on YouTube. Members get priority deep dives on tickers like this one, and we're covering all of the S&P 500 stocks over the next few months, exclusive priority access for members.
And if you just want one specific stock covered,
Just drop us a super thanks. Easy as that. Okay, let's unpack this dramatic corporate reinvention. Asset Entities isn't just changing, it's being completely, deliberately replaced.
wiped clean, almost.
Right. So to understand its future, we have to look at both the company it was and the completely different entity it's becoming. This brings us right into Chapter 1, Business Analysis, a tale of two companies. Let's start with the legacy model, the social media innovator, the past.
Okay.
Before September 9, 2025, ASST was a tech company, right? Firmly in the creator economy. They were targeting Gen Z audiences, doing social media marketing, management, content delivery. Think Discord, TikTok, Instagram, YouTube.
Usual suspects for Gen Z.
Exactly.
Okay.
Their key stuff included AE.360.ddm for Discord server management, their social influencer network sit-in, they called it for white label marketing, and the ternary payment platform, which was a Stripe-verified CRM tool for Discord.
So niche tools for a specific audience.
Yeah, and their big value proposition. They claimed a deep native understanding of Gen Z. But here's the stark reality.
It didn't work out financially.
Not even close. The model failed to achieve profitability or significant revenue growth. It just couldn't get off the ground. Now, hold on to your hats, because here comes the new model, the Bitcoin Treasury Company.
The big pivot.
As of September 9, 2025, shareholders approved a merger with Strive Enterprises. The combined company will be Strive Inc., but, and this is interesting, it keeps the ASST ticker.
Keeps it the history, in a way.
Maybe. Its core objective. It's now officially a Bitcoin treasury company. Its entire purpose is to acquire and hold as much Bitcoin as possible on its balance sheet.
Providing investors direct price exposure to Bitcoin, then.
Precisely. Its stated mission is crystal clear. Maximize Bitcoin per share and outperform Bitcoin's price long term. And revenue. Forget services. It shifts entirely to Bitcoin price appreciation.
Wow. All in.
All in. They even have what they call an alpha generating strategy, basically looking for bargains. They plan to acquire distressed Bitcoin claims from bankrupt entities like Mt. Gox.
Trying to buy Bitcoin below market price.
Exactly. Potentially getting it at a significant discount.
Okay, what's truly fascinating here is how explicit and radical this shift is. They're not just adding Bitcoin to their treasury like some companies.
No, they are the treasury.
They are becoming a Bitcoin treasury. This fundamentally redefines their playing field. So my question is, what does that mean for the industries? Where they've come from and where they're going? Well, they're completely ditching the creator economy.
Yeah, walking away.
And that's a massive market, right? Valued over $200 billion in 2024, projected to grow like crazy, maybe $1.3 trillion by 2033. You've got trends like short-form video, generative AI, socialist search.
Huge growth potential.
Huge potential, yes.
Yeah.
But, and this is crucial, the sources tell us it's also Intensely competitive, fragmented, and characterized by low barriers to entry.
So tough to stand out.
Very tough. And AST struggled to build a profitable enterprise within it. So while they're leaving a growing market, they're also leaving somewhere they just couldn't make money.
Fair enough. So where are they landing?
They are fully entering the Bitcoin treasury space.
Yeah.
Now, this is more niche, but high profile and definitely growing.
Right.
It offers compliant, indirect Bitcoin exposure. That's really valuable for institutional investors who might have rules against holding crypto directly.
Like pension funds, maybe?
Exactly. Think of key players here like MicroStrategy, MSTR, or the big Bitcoin miners like Marathon, Digital, MARA, and Riot Platforms or IoT.
Okay.
The growth of this new industry is naturally inextricably linked to the price appreciation, broader adoption of Bitcoin. It lives and dies with Bitcoin.
Makes sense.
Mm-hmm.
So what advantages does this new Strive Inc. actually have?
Okay, looking at the competitive advantages for the new Strive Inc., they're pretty distinct. First, huge access to public capital markets.
That PI-PE deal.
That massive $750 million private investment in public equity, the PI-PE financing. Plus, potential for another $750 million through warrants. This ability to raise capital at a scale far beyond the reach of private companies is absolutely central.
Okay, big money. What else?
Second, they're rolling out an innovative tax advantage structure and equity for Bitcoin exchange under Section 351.
Break that down a bit.
Okay, imagine you're a big Bitcoin holder. You want to move it into a company structure, maybe for diversification or estate planning, but selling triggers a big tax hit.
Right, capital gains.
Exactly. This structure lets you swap your Bitcoin for shares in Strive, tax-free at that moment. It helps them bring large amounts of Bitcoin onto their balance sheet very efficiently.
Clever.
Then there's the leadership credibility. Matt Cole, coming from CalPERS, managing $70 billion. That carries weight.
Institutional clout.
Definitely. And finally, a zero-debt profile starting out. That's crucial. Gives them flexibility and reduces insolvency risk, especially with Bitcoin's wild swings.
So what's the bottom line here? What's the core insight from this business shift?
Well, this wasn't just a new chapter. It's a completely different book.
Right.
The pivot wasn't evolution. It was a stark admission of failure. The old social media business. Less than $1 million in trailing 12-month revenue.
Wow.
While burning through cash with net losses over $7.6 million. And that return on invested capital, the ROIC, minus 209.97%.
Minus 200%. So for every dollar invested.
They were destroying more than $2. It was an unsustainable cash burn, making the pivot a real bet-the-company move.
No kidding.
The source highlights that Strive's future success is now entirely decoupled from that past performance. It's wholly dependent on two factors: the market price of Bitcoin and the new management team's ability to execute its accumulation strategy. Full stop.
Okay, so we've seen the business pivot. Now let's talk about the people driving it. This transformation isn't just the model. It's a complete changing of the guard. That brings us to Chapter 2, management evaluation. The changing of the guard.
Crucial chapter.
Because the investment thesis here is really as much a bet on the new management as it is on Bitcoin itself, right?
Absolutely. People are key here.
So let's quickly remember the founding team. Led by co-founder Arshia Sarkani. They were described as, young, dynamic, successful entrepreneurs, deep understanding of Gen Z.
The narrative was strong initially.
It was. They did identify the Discord market, took the company public, but financially, well, they left a track record of significant value destruction, consistent losses, cash burn. It forced this radical pivot. The numbers just weren't there.
Yeah, the reality didn't match the story.
Exactly. Now, the new leadership is a very different story. The cornerstone of the bull case is Matt Cole, the new CEO and chairman.
The CalPERS guy.
That CalPERS guy.
Yeah.
Over 16 years institutional investment experience, managed over $70 billion in fixed income portfolios there. And here's the kicker. The funds he managed never underperformed their benchmarks.
That's impressive. Serious credibility.
Serious credibility. His background is deep in institutional strategy, risk management, large-scale capital deployment. Interestingly, Arshia Sarkani, the former CEO...
What's his role now?
He's staying on as chief marketing officer and a board member. The idea is to leverage his social media expertise for the brand narrative, engage the retail investor community, sort of bridging the old and new.
That's a really deliberate fusion, isn't it? Cole's CalPERS pedigree brings that vital institutional credibility.
Wall Street appeal?
Right, while Sarkani's role targets the retail and crypto-native communities. Zooming out, it's a strategic play to appeal to both sides.
Makes sense.
However, it absolutely introduces significant key man risk. The whole thesis rests very heavily on Matt Cole's reputation and his ability to execute.
That's a powerful point about key man risk. A lot riding on Cole.
A huge amount.
But, like you hinted, the alternative wasn't working. Now, when it comes to capital allocation, the pivot here is just monumental.
Total commitment.
The board abandoned the core business entirely. 100% of the company's future is now allocated towards acquiring Bitcoin, their investment and M&A strategy. Aggressive. Continuous acquisition funded by that $750 million PIPE.
Which could double to $1.5 billion.
Exactly. And there's that sophisticated element we mentioned, targeting distressed Bitcoin claims, specifically mentioning the 75,000 BTC linked to the collapsed Mt. Gox exchange.
Right, trying to get Bitcoin for less than market price.
Right.
Buying distressed debt.
It's an opportunistic and potentially alpha-generating approach. Gives them an edge if they pull it off, but don't expect shareholder returns like dividend or buyback.
No, all capital goes into Bitcoin.
All in. And future dilution from issuing new shares to buy more Bitcoin seems likely. We have to keep mentioning the historical ROIC. Deeply negative, minus 209.97%.
A stark reminder of why they pivoted.
Yeah, it signals that every dollar invested in the old business was being destroyed, making the pivot a necessary attempt to stop the destruction of shareholder capital. Okay, let's move on to Chapter 3. Financial analysis, a clean shell for a new purpose. Understanding the context of this merger is critical, the financial state of legacy asset entities. Well, it was pretty dire.
Yeah, a clear picture of a company struggling.
Which, ironically, made it a prime candidate for a reverse merger like this.
A clean slate, almost.
Looking at the key metrics for legacy ASST just before the change, September 10th, 2025. Market cap around $104.4 million. Revenue growth, minimal, stagnant. TTM revenue just $759,690.
Barely anything for a public company.
Right, profit margins. Well, this is where it gets ugly. Gross margin, 28.62%. Okay, not great, but... Net profit margin, a staggering minus 1,009.32%.
Minus 1,000%. Wow.
Yeah, let that sink in. For every dollar of revenue, they spent more than $10 in costs and expenses.
That's not just struggling, that's a financial black hole.
Totally. Free cash flow showed the company hemorrhaging cash. Negative $1.69 million net change in cash for the quarter. TTM EBITDA, negative $7.64 million. Survival dependent on its ability to continually raise outside capital.
Burning through money fast.
And earnings consistency.
Yeah.
Consistently negative and getting worse. A 64.4% decline over 5 years. However, for all that doom and gloom, this struggling company had two key features, things that made it an ideal merger vehicle, a true clean shell for this new purpose.
What were they?
Number one, a 0% debt-to-equity ratio, no debt.
Ah, very important. Critical.
Critical. Allowed Strive to merge without inheriting liabilities, and the new company plans to maintain this zero debt profile.
Smart move with Bitcoin's volatility.
Exactly. Second, a strong current ratio, 4.74x, good short-term liquidity. And as we said, no dividends planned, all capital straight into Bitcoin.
Okay, so given those really dire past financials and this radical transformation, the obvious question is, how on earth do you value this new company?
Right. Traditional methods just seem irrelevant.
They are entirely relevant here. When we look at valuation analysis, traditional metrics like PE ratio, negative, meaningless. PS ratio, extraordinarily high, over 81x, completely disconnected from the old revenue stream.
So forget the old metrics.
Completely. For the new Strive, Inc., the only meaningful comparison is to other Bitcoin treasury companies. The key metric to watch, the company's enterprise value, EV, relative to the market value of its Bitcoin holdings.
It's premium or discount to NAV.
Exactly. It's premium or discount to net asset value. If we look at peers, MicroStrategy's EV per Bitcoin held is around $182,700. Marathon Digital around $200K. Riot Platforms way up at $322,000.
And where does Strive fit in, potentially?
Well, Strive, Inc. pro forma, meaning assuming that $750 million PIPE comes in and Bitcoin's at, say, $112,000, it's estimated to be around $127,000 EV per Bitcoin held.
So potentially launching at a discount to some peers.
Potentially, yes. As for intrinsic valuation, like a discounted cash flow, or DCF, impossible for the new Strive. Its value is just a direct function of Bitcoin's future price.
Too unpredictable.
Way too unpredictable. You could do an educational DCF, projecting the future market value of Bitcoin holdings, but you'd have to use a very high discount rate of 25–30% or more because of the extreme volatility and execution risks. It just leads to a very wide range of potential present values. Basically, it tells you it could be worth anything from very little to a whole lot.
So the bottom line on valuation is Watch that premium or discount to the market value of its Bitcoin holdings. That becomes the single most important metric.
Exactly. It tells us what the market truly thinks of Matt Cole's strategy and Strive's future prospects.
Okay, that wraps up the foundation, the business, management, financials. Now, let's shift gears. Let's dive into the future landscape for Strive. We begin with Chapter 4, Market Sentiment, a Battleground Stock.
And battleground seems like the right word here.
It really does. What's fascinating is how polarized the market's view of asset entities is right now.
Totally split.
Looking at market perception, well, there's zero traditional Wall Street analyst coverage. Not surprising for a microcap undergoing this kind of change.
No official ratings to go by?
Nope. AI-driven quantitative services looking mostly at historical data, generally rated a hold with a low probability of outperforming the S&P 500. Basically saying, be cautious given the past and the volatility.
Based on the numbers they have.
Right. But the news impact, immense. The narrative is exclusively focused on the merger, and this news flow has driven extreme price volatility.
We saw those jumps.
Yeah, shares soared 63% on social media buzz, another 35% after the merger approval. It's pure high-stakes speculation, attracting exactly the kind of high-risk traders looking for those explosive moves.
Okay, but beyond the headlines and the hype, what do the underlying market indicators tell us about investor positioning, potential moves?
This is where it gets really interesting. Short interest.
Big one.
Arguably the most critical market indicator for AST right now. As of August 15th, 2025, get this. Short interest was an astonishing 122.40% of the public float.
122%. That's possible.
Apparently. It means more shares sold short than are available for public trading. It signals a massive concentrated bet against the stock. People are really betting it will fail.
Wow. But doesn't that create another dynamic?
Absolutely. It creates perfect conditions for a short squeeze, where forced buying, if the price moves up, could send it dramatically higher. It's a tinderbox for extreme volatility, a powder keg.
High risk, high reward, even just on the trading dynamics.
Totally. Looking quickly at price relative to moving averages. Current price, around $5.33, is below the 50-day moving average, $5.94, suggesting maybe a short-term downtrend or consolidation.
But volatile.
Very. It had crossed above it just 2 days prior. Shows how fast things change. However, the current price is comfortably above the 200-day moving average, which is generally seen as a more bullish long-term signal.
So conflicting signals even there.
Exactly. You've got this real tug of war. On one side, the Bitcoin believers, the short squeeze watchers. On the other, the skeptics making these huge short bets. This isn't just volatility, it's a market deeply divided, a true battleground stock. Now, connecting this to the bigger picture, understanding who actually owns a company like ASST tells us a lot about the forces shaping its price and strategy. Let's move to Chapter 5. Ownership structure, who holds the cards?
Right, follow the money.
Because the ownership here is highly concentrated and it's about to shift dramatically.
With the merger and Pipe E.
Exactly. Looking at stakeholder analysis pre-merger, top institutional ownership was highly concentrated. 81.64% of shares were held by institutions.
Wow, very concentrated.
Pantera Capital Partners LP was the largest holder, with a massive 44.62% stake.
Pantera. They're a well-respected blockchain VC, right?
They are, so their holding provides a powerful endorsement for this Bitcoin pivot. You also had firms like Citadel and Steadfast Capital Management with significant positions, over 7% and 5% respectively, though their strategies might be more complex, maybe arbitrage or something.
Not necessarily long-term believers.
Could be. Vanguard Group held 3.81%, probably just passive indexing. But insider holdings, that tells a different story pre-merger. Significant net selling by insiders in the past 12 months.
Founders cashing out.
Looks like it. Executive Chairman Michael Gaubert, CFO Matthew Kruger, selling shares in June 2025. This contrasts with the significant ownership that will be taken by the new management and investors after the merger. It signals that changing of the guard we talked about, even in ownership.
Yeah, what's really striking is how much power just a few major players have right now.
Yeah.
But like you said, this high concentration is temporary.
About to change drastically.
That merger and the $750 million PIPE financing, they're going to introduce a massive number of new shares, a completely new slate of institutional owners. It will dramatically alter the ownership landscape and the public float.
And what's the risk there?
Well, this huge influx of shares could create significant selling pressure if those new investors decide to take quick profits. Could lead to even more volatility.
Okay, makes sense. Now, no deep dive is complete without a thorough risk assessment. We're looking at what's effectively a brand new company.
Gotta look at the SWOT.
Exactly. We need to analyze its strengths, weaknesses, opportunities, and threats, focusing entirely on this new Bitcoin treasury model. Let's dig into Chapter 6, Risk Assessment, a SWOT for the new Strive, Inc., starting with strengths. Core internal competencies. First, experience new leadership. Matt Cole, unparalleled institutional credibility from CalPERS.
Huge asset.
Second, significant capitalization. Exceptionally well-funded from day one with that $750 million plus PIPE.
Money talk.
Third, clean balance sheet. Starting with a zero debt profile, huge financial flexibility. And fourth, that innovative acquisition strategy. Tax-advantaged swaps, pursuing distressed assets like Mt. Doc's claims for significant alpha. They're not just passively holding.
Proactive strategy. Okay, what about weaknesses? Internal limitations.
All right, weaknesses. One, absolutely no operating history. This new model is, at this point, theoretical. It hasn't been proven.
Pure projection right now.
Two, complete asset concentration. 100% concentration in a single, highly volatile asset, Bitcoin. A prolonged bear market would be absolutely devastating.
All eggs in one very volatile basket.
Three, execution risk is high. Acquiring those distressed assets, it's complex and fraught with legal, logistical, and financial risks. Not easy to pull off.
Lots can go wrong there.
And finally, potential for management distraction. Pivoting a public company this radically is a monumental task, demands intense focus. Could they get spread too thin?
Fair point. Stepping back then, it's clear the external environment has both immense potential and significant headwinds. The scale of these threats really underscores just how speculative this whole venture is.
Let's look at opportunities first. Future market potential.
Okay. Strive is positioned perfectly for the growing institutional adoption of Bitcoin, right? Ready to capitalize as more corporations and institutions allocate to digital assets.
Riding that wave.
Riding that wave. Plus, those market inefficiencies in the kind of opaque market for distressed crypto assets, that offers significant opportunity for their alpha-generating strategy.
If they can navigate it.
If they can navigate it. And there's the potential for a valuation premium. We've seen well-regarded Bitcoin proxy stocks like MicroStrategy, sometimes traded at a premium to their actual Bitcoin holdings. Market likes the management or the structure.
Okay, those are the upsides. Now the threats, external challenges.
And these are substantial. The single greatest threat. Extreme Bitcoin price volatility.
Obviously.
It would directly and negatively impact the company's valuation, period. Then there's regulatory risk. The landscape for crypto is still uncertain, could change dramatically and negatively.
A sword hanging over the whole space.
Definitely. Intense competition from established players like MicroStrategy, which has a multi-year head start and deep experience. They're not alone in this space.
True.
Key macroeconomic factors matter too. High interest rates are generally a headwind for speculative assets like Bitcoin. Lower rates could be a tailwind.
The broader economy plays a role.
And finally, systemic risk. As more leveraged corporate vehicles buy crypto, it introduces new systemic risks. Could a downturn trigger forced selling and a contagion effect? It's a possibility.
Okay, a lot to consider there on the risks front. So let's bring it all together. What's the key takeaway from all this for you, the learner? This deep dive into Asset Entities, Inc., it shows this isn't a traditional investment.
Not at all.
It's a highly speculative debt on a corporate transformation and a single volatile asset. That brings us to Chapter 7. Conclusion, the ultimate speculative bet. The arguments for and against this are just stark.
Very compelling on both sides.
The bull case, the potential for a home run, it's genuinely strong. You get a pure play leveraged vehicle for Bitcoin price appreciation.
Direct exposure, amplified maybe.
Right. Led by a new CEO, Matt Cole, with that unparalleled institutional credibility. Launching with a massive war chest, $750 million plus, and a sophisticated strategy to generate alpha, not just track Bitcoin.
The smart money angle.
Exactly.
Yeah.
For bulls, it's a rare opportunity to invest alongside a top-tier manager in a vehicle designed to aggressively capitalize on the long-term institutional adoption of Bitcoin. But the bear case, the risk of a strikeout, equally potent.
Just as strong, yeah.
This is an unproven venture with no operating history, housed in a previously failed microcap company. That history matters.
Can it grow the past?
It has a single point of failure, the price of Bitcoin, one of the most volatile assets in the world. A prolonged crypto winter could be catastrophic.
Game over, potentially.
And that astronomical short interest of over 122% of the float, It signals a large and convicted group of investors believes the stock is destined to fail.
They're putting their money where their mouth is.
For bears, it's a speculative bubble, a company with no fundamental value whose fate is tied to a risky asset and market sentiment.
So this really raises that fundamental question again. How do we even think about the value of such a company?
Right. It's not like valuing a company with predictable earnings.
Exactly. A traditional valuation of asset entities, now Strive, is truly not possible or meaningful. Its intrinsic value is just a direct function of the future price of Bitcoin,
Which no one knows.
heavily discounted for all those significant execution, market, and regulatory risks we talked about. It's best understood not as a stock in an operating company, but more like a publicly traded call option on the future of Bitcoin and the execution skill of Matt Cole and his team.
A leveraged bet on Bitcoin and management.
Pretty much. It's pure leverage and execution risk wrapped in a public company structure.
So, for our concluding outlook,
AST's share price, around $5.33 as of September 10th, 2025, clearly reflects a market in extreme disagreement. It's a high-risk, high-reward proposition.
no middle ground here.
Very little. The path forward won't be dictated by quarterly earnings reports. It'll be driven by the price of Bitcoin and the market's continued faith in the new leadership. This is not an investment for the faint of heart or anyone with a short time horizon. It's much more akin to a venture capital bet on a potentially transformative idea than a traditional equity investment.
Wow. So, this dramatic pivot by asset entities, now Strive, Inc., it really challenges our definition of what a public company can even be, doesn't it?
It absolutely does.
In this age of rapid tech shifts, financial innovation, are we seeing the future of corporate strategy here, or is it just a new frontier of speculation?
Fascinating question.
What does it truly mean to invest in value when a company's fate is so tightly bound to a single volatile digital asset? Something for you to mull over. That's all for this deep dive into AST. We really hope you found these insights valuable.
Yeah, I hope it was useful.
Don't forget to like and subscribe to Stock Analytics AI for more deep dives just like this one. Remember, members get priority access to our analysis on all the S&P 500 stocks we're covering.
And the super thanks for one-offs?
And the super thanks option if you want a specific ticker covered.
As always, just a reminder, this analysis was generated by an AI system. It's for educational purposes only and should definitely not be considered financial advice.
Please do your own research.
Please conduct your own research or consult with a qualified financial advisor before making any investment decisions. Thanks for joining us today.